I mean, the whole thing is going to be a mess, a huge, great mess. And trying to manage your way through that, I think is going to be very, very challenging. And my strategy, I think, would be, get gold now, because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, I mean, this is plainly ridiculous. It should be 30 or lower.
Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing the worst settlement. You're paying them a 60 basis point management fee. You can store in one of our BRICS facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100, you got 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central bank started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this. And at the same time, but that excluded the New York traders all this time until November of this year. And now every month you're seeing deliveries like this of millions of ounces of gold and silver every single month, billions of dollars worth every single month. And again, call it reverse psychology, use it contrarianism. That's a word. Why isn't anyone talking about this on the mainstream? Why do you not hear about the record deliveries? Who's taking billions upon billions upon billions? I mean, keep on going, billions upon billions every single month. Who's doing it? Who's bleeding dry the LBMA? Why is there no talk of this? It is because the lack of journalistic integrity or effort on their behalf to tell anyone what's truly happening, including the people who are trying to decide which way to invest, is ridiculous. And it's just like this pullback that we've seen, right? The mainstream media is all over it. And a lot of the things they said are valid. A lot of them are. It was overbought. It had gone up for 9 straight weeks. It had blown through moving averages. It was in need of a correction. They capitalize on all of that, and then they'll put a cap on and say maybe it's topped and it's over, just like in 2011 and 1980 before that. But what they fail to mention, which invalidates all of it, is that, the snowball that was pushed down the hill to start this going in the access market, when New York was closed, when there were no markets open, before Asia opened, when no trader, Alasdair will tell you, that trader would be fired and shot, and not in that order. Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing the worst settlement. And then, of course, who did I mention? Bank of America and Morgan Stanley? Well, Michael Lynch says they came right in and scooped up physical, shows the numbers, and silver went right up. So this is all a game that is being done for maximizing the effect, the fear. And there is not one rational trader on the planet that would do that, would dump it in the access market. They would dump it over hours or days, slowly bleeding it into the system, not telling these traders how much they want to sell, slowly, so that the demand would be commensurate with the supply. But they fail to tell you that. They should have said all of these things are true, but they dumped it. They dumped it when there was no market open. So everything they say is invalidated. And all the sell stops that triggered, freaking everyone out, getting all what's going on with gold, what's going on with silver. They never called when gold was going up for 9 straight weeks in a row. And I think the powers that be understood we were entering a period of time where the public was waking up. That's a bad thing when you have a wicked short position. It was damage control. It was short covering. It was fugazi. And you'll see it right back up, I promise you, before the music stops. If this had been done the right way, slowly bled out over days and weeks in New York trading, I'd be less confident. But any idiot, stupid idiot that would dump it like that when there's no traders, well, that invalidates everything that the media said, no matter how rational and logical and valid those statements may be otherwise. That's just my 2 cents.
Well, I actually want to just pick up on an earlier point you were making, Andy. The largest mine in the world is COMEX, because this year so far it's delivered around about 1,200 tons. That's three times China's total gold mining effort, annual effort.
There you go. And who is it? And why don't we hear who it is?
Well, that's for us to guess, isn't it? When Bretton Woods ended, there was a big propaganda effort by the US Treasury to persuade everybody that gold was no longer part of the monetary system. Now, I think it's important to know that that actually goes against common law. Common law is that gold is final settlement and everything else is credit. And this goes back to the first set of laws produced in Rome, which were at 448 BC. That was refined by jurors in the following decades, following centuries, and then incorporated in Justinian's Pandex. And of course, out of the Roman Empire came all the countries, the European countries, from the Urals, or if you like, from Russia all the way through to Portugal, who went out and colonized the world, including the great US of A. So everyone's common laws outside China and so on and so forth, which is somewhat different, everyone's common laws had the same thing, and that is that physical metal, gold, silver, was final settlement and everything else was credit, including fiat currencies. That's the important point. They are credit. And the value of a fiat currency depends on 2 things. Firstly, the quantity of its issue, and secondly, the faith that its users have in the value of that currency. And the problem is that fiat currencies always come to an end. And we've had this regime now, based on propaganda, no more, for 54 years. It's coming to an end, in my view. Why is it coming to an end? It's coming to an end because governments use fiat currencies always as a means of accumulating debt without having to, if you like, keep the value of that currency tied to gold, which limits, it cramps their style. It really does cramp a government style. So you always find that these fiat currencies end in a massive mountain of debt. That then collapses in terms of its value or counterparty or bankruptcies or whatever. And so are we close to that point? I think we're getting pretty close to it, is my view. And when it happens, everything changes. Absolutely everything changes. And I think, I'm very glad I don't actually manage money anymore, but it seems to me that this is going to be very, very difficult for investment managers to handle. And this is why I say, I've tried to sort of say earlier on, and I know people have joined since we started this, that the first thing to observe is the bursting of the credit bubble, which has been funded basically by the expansion of bank credit. That's where bank credit has been going. That's why the S&P has risen by, 50, 60, 70% or whatever in the last 2-3 years. That's the first thing. Now, when it pops, when it bursts, then you will find that everything which people own in portfolios will be sold down, particularly where they've got profits, because they will, it's human nature. When it comes to the losses, you just ride them. But what you do is you liquidate the things that have been performing well, that you got good money on. So I think even gold mines would be sold out. But the one thing they haven't got is physical metal. They don't own physical ETFs, etc. And I think that when the bubble pops, I mean, you may have to count up to 10 or something before it happens. But the next phase will be bond yields rising, making the situation worse, foreclosures in the market. You'll find foreigners